So this is the trajectory, log linear. So again, a straight line qualifies constant rate of return. Again, you see, just with the eye, you don't need to be a super strong statistician and econometrician to see this upward curvature that reflects the growth rate, the growth itself, plus this structure that takes into account this spells of panics. So this is a quite nice example of a bubble that we think, I mean, it's difficult to say when it started, but somewhere in the mid or early 1980s, and there are reasons to actually support this more. The next big bubble I was mentioning, again, a log scale, linear scale, super exponential behavior, punctuated by this oscillation. This was the case, so in 1980, it was too, 87, it was too early. We did, of course, post-mortem, ex-post analysis. This one is one of the ex-ante analysis 14 years ago, where we are following. And remember, I mean, this was the beginning of really of our systematic study of the bubbles. We just, in this case, sold our assets. I remember I was with my postdoc, Anders Joensen, and we said, okay, we are going to sell everything, and we sell around beginning of 2000 in order to avoid the crash. The next one I was mentioning is the massive bubble on the stock market in the US. Again, log scale linear, and you see all this structure. You see a much more sophisticated analysis now with a band of confidence, which is the 80% confidence for which you can find the TC, the critical time of the chain of regime. The dots correspond to the price on the daily basis. And this is a beautiful example, beautiful for us confirmation that indeed the process was absolutely unsustainable and would break down into a correction. So looking at the same data, by the way, so this is just a chain of scale here to show the aftermath of, more in detail what is happening here. I've spoken about positive feedback and bubbles. I should say positive bubbles also. So positive bubble is when the price goes up. But imagine now that I think of coming back to the example of Swiss franc in euro. Remember, we showed Swiss franc in euro going up and crashing. Now, let me think as euro and Swiss franc. It's exactly the opposite, especially if I look at the log scale. It's exactly the minus. You just flip this through a symmetry by the horizontal. So you have this and a rally. So this, we can call it a negative bubble with a rally and a negative crash. Yes? So it's easy to understand now that maybe you can extend the concept of negative bubbles to also assets. That indeed, there are times when there is positive feedback on negative bubbles. Yeah? So it means that there's some processes that tends to create a spiral of losses that feeds on itself, like a spiral of fear that aggravates the situation and gives, let's say, overshoot. Okay, and this is our interpretation of what happened after the peak and so on, with the same calibration of the same type of technology, which is interesting because then it predicts a rebound, possible rebound. By the way, the Lehman Brothers event, you remember, for 15 September 2008, yeah, is just a part of this drop here. I think it's from here to here. That's often what is considered or attributed to the Lehman Brothers. For us, it is just an event in a much broader picture of a kind of self-sustained or auto-amplifying panic that was also not sustainable and had to recover either or through a combination of investor behavior as well as central planners, policymakers, central bank, and so on. I was mentioning also the other example of other bubbles developing until the crisis. The oil bubble is a beautiful example of a component of speculation on top of a fundamental process. I remember the time we were analyzing and discussing with Paul Krugman. Paul Krugman was essentially arguing that it is all the price skyrocketing had all to do with inventory problem and supply demand, with India and China needing oil for their economy. Our analysis clearly suggested there was an additional speculative component, and we also documented ex ante in advance the existence of this bubble and published probable time of the corrections. Of course, correctly, you see here in brown, in gray color, the different scenarios and the 80% probability for the TC, the critical time to occur. Other examples all over the place, and it was dramatic for social stability worldwide. Indonesia, the Arab Spring, and so on, has been in large part, in large part due to these bubbles on commodities, in particular on food price. You see a remarkable, by the way, correlation between the doubling of the price over the last 20 years with a massive social unrest in different countries in the world. In the same way, as a Frenchman, I cannot but remember that the French Revolution was mostly due to a decade of drought and famine. So economics has a fundamental impact in history, even now. And of course, the mother of all bubbles is debts. The debts in the financial and the non-financial sector of the US in units of GDP, and you see these non-sustainable positive feedback processes, where also in the debts, the more debts seem to actually, from various reasons and processes, give rise to this totally unsustainable regime. Another way of looking at it is looking at a quantity that often economists look at, which is the increase of GDP, in this case again the US, per dollar of debts increase. So ideally, the idea is for any person, for company, I take debts, okay, to consume a bit more, but also to buy or to develop a factory so that I'm going to get future incomes. So it will normally, new debts is to invest to grow the economy, right? Okay, it used to be very efficient 20 years ago. Now $1 of new debts gives $0.1 of new GDP. And it actually through a trajectory that is bound to give $1 of new debts gives 0 or negative even growth essentially soon. So in terms of the metrics that we can look at in order to characterize different crises, you may have heard about the term the Great Moderation. Yes? Who has heard of Great Moderation? Yeah, one. Who has not heard about Great Moderation? Okay, so you have neither heard or heard of the Great Moderation. So you are all sleeping. Okay, so Great Moderation, it's the term made famous by Bernanke, the present chairman of the US Federal Reserve. Actually, the term was not his invention, it was by an economist earlier. But it is summarizing the belief and essentially the understanding of policymakers, central bankers, Bernanke, Greenspan, Robbins, Summers, the Treasury Secretary, the finance minister of the US, and many economists, that until the crisis, essentially, roughly 25 years before it, we had a period which was fantastic. You see on the top, I don't show econometric statistics, but you can see with your eyes, and of course this is all backed up by a lot of econometrics. So you could see strong GDP growth, sustained, predictable, low volatility, what a policymaker would like, so that you have a predictable tax revenue. You could see predictable, smooth inflation, contained inflation, predictable inflation, the perfect also situation for a policymaker. Unemployment was fast but contained, and also, I don't show the curve, but also in the last decade, before the crisis, quite low, surprising low volatility in the financial market. It looks like, we had it all in the West. It was perfect for 20 years. And of course, all the commentators now and the analysts recognize that the last 20 years before the crisis have been the best 25 years ever in the history of the West, in particular the US. Now, it's very interesting because these were the diagnostic and the metrics that they were using in order to decide their policies. And Lucas, Nobel Prize winner, in his presidential address in the American Financial Association, I think in 2003, 2004, said, yeah, we have mastered the beast, we will never have any recession anymore. Because of this, because of the financialization, the innovation, the risk diversification, this networking and so on, led to the belief, and this is famous in many discourses by Greenspan, in particular in front of Congress, that with all this technology and these deregulations, we have created a world where those who do not want the risk can sell the risk to those who want the risk or who are strong enough to take the risks. What they forget is to look at all the evidence that I've been showing you since the beginning, that we were in a massive super bubble for the last 25 years, punctuated by actually a series of bubbles like the one that burst in 1980 and so on. What is interesting is that now, I was at a conference at the Frankfurt, organized by the Fed and the ECB, European Central Bank, and some of the same economists concluded that these indicators were really abnormal. So I don't know if you realize what I just said. It means that in hindsight, this is called the hindsight bias in psychology. In hindsight, once you know the system has broken, you see these indicators are really tell sign of something misfunctioning. But before the crisis, these indicators tell you, perfect, we control the beast, no crisis anymore, and we can continue the policy. So when I heard this by this economist concluding the conference, I jumped on my feet and said, come on, I mean, this is hindsight bias. You know, I mean, remember your psychology and your state of mind before the crisis, and you can recognize it and then continue this discourse and so on. But this is extraordinarily interesting and important because we are never going to make any progress because we are completely dominated by this hindsight bias. And I see it all the time. Once we have seen a crisis, the regulators regulate against the past problem. Say, oh, it's obvious. I mean, we are just going to put this requirement, this capital ratio, you know, it will solve the problem. Yeah, it solved the past problem. Like the famous Maginot Line in France, you know, which was built to stop the German army, which was perfect for solving the First World War, but the problem that was built after the First World War, from the lesson of the First World War, which was completely, I would say, irrelevant with the technology of the Second World War, as famously the Panzer just went around super fast in Belgium. So this is really an important thing that we need to look at bubbles, to look at these indicators, otherwise we can be misled for quite a while that the economy is very well. Yes, it is at the price of these non-sustainable dynamics that give instantaneously over a short time impression that everybody is wealthy. And it was true. At that time, everybody was feeling rich. And famously, the CEO of Citibank, Prince, said, yeah, we knew something was not sustainable, but how can you stop dancing? How can you stop dancing when everybody feels richer? Everybody, from the top to the bottom of the society. So, the understanding of where we are now, in order to, and this will be, I will not take too much time, 15 minutes more, to paint you the future, where we are, I mean, what we can expect, is the realization that now, I mean, since 2008, we are in a hangover of a massive set of bubbles, which basically started somewhere in the 1980s. And you can see, and I just show you a few indicators here, you see everywhere there's a change of regime in essentially all indicators around the 1980s. And the story is the following, that after the Second World War, in the West there was a massive reconstruction, but also here, of course, a massive reconstruction and productivity gains. You know, in economics, everything is about productivity, because this is the engine of growth and the engine of creation of wealth. And so you really had productive growth. And then productive growth essentially stopped or really slowed down a lot in the 70s. And what happened is that in the 80s, the growth of the economy in the West was compensated by debt in the private sector and financial growth. So that the weight of finance in the GDP component of the West grew from 4% to 8 or 10%. And this was what I call this perpetual money machine, where extract wealth from a virtual environment. It works for a while, until, of course, the real economy is not able to match the growth of the financial sector. And we have had this succession of bubbles as many attempts to, let's say, lead through this illusion, and the great crisis of 2008 is the culmination of this wave of instability. By the way, another indicator which is very interesting, when you look at around also 80s, 1980, 83, the rate of profit from investment skyrockets. The savings go down. This is data for Europe, Japan, and US, aggregated. Similarly, I don't show it, but the curves are exactly the same. The wage were here, the consumption were here, then the wage go down, and the consumption go here. Is it sustainable? To have consumption growing very fast while the wage go down, it is sustainable as long as the rate of profit extracted from the stock market and for real estate market will continue. But this was, as you understood, totally unsustainable. So this is where we are. Summary. Okay, you got it, I hope. Bubbles result from positive feedback. They are all over the place. Positive feedbacks are ubiquitous. In investment hedging for rational reasons, technical reasons, but also in addition for behavioral reasons. This is, in a way, support quantitatively precisely the Minsky instability hypothesis. Maybe you have heard of the term the Minsky moment, which has been famous. Minsky is an economist that in the 80s, 90s, developed this idea that there are three steps in financial dynamics, and there is reason to think that financial markets are not the stable processes that give rise to equilibrium, but they give rise to intermittent instabilities. They are in some sense self-correcting, but in a very abrupt way, as opposed to the smooth mean reversal that you learn in textbooks. So there's been an illusion that economic growth in developed countries since the 1980s was real. In large part, it was fueled by debts and financial innovation, and without enough spillover of this productive growth of the real economy. By the way, what is understood now is that the so-called great 3% productive growth in the last 30 years before the crisis in the US was 2/3 of it due to financial sector. 1/3, 1% only in the real economy. Only realized after the crisis, by the way. Okay, change of regime in the 70s, 80s, also as to do with the President Wood, the shock oil and so on, but really the world were trying to find a new engine of growth, and we found it by debts and financial deflation. So we are here now in the aftermath of these 30 years of excesses, and we have to digest it. And how do we digest it? By more debt, more consumption, and more bubbles. So, and I showed you about the 7 major bubbles that led to the crisis. Okay, now, building on this, let me tell you a bit the state of the world. Okay? So we have this financial crisis observatory at ITH Zurich. We follow 25,000 assets on a daily basis, and I just show you a little bit here some presentation, how it looks like. Time axis, the red corresponds to identifying an ongoing positive bubble in a given asset. The green corresponds to a negative bubble, something which goes down, which can rebound. This can be applied to real estate market. For example, here you see Switzerland, and on a biannual basis, we analyze a fantastic database, which is, there's a company which is called Comparis, which has all the advertisement of real estate. Maybe this is a business which is interesting. I'm sure there is the equivalent, and maybe Saga, you could get the data, where here we have millions and millions of advertisement over the last 10 years, roughly. These advertisements correspond to properties, flats, houses that are on the market. They correspond to what we call in finance ask price, because it's the owner who say, okay, I sell my apartment for 1 million, whatever, 1 million. We can check by working with banks whether the ask is close to the realized price, and with this, it's very interesting. In Switzerland, it's probably not the same in every country. Often the ask price is below the transaction price. So, because there is competition for scarce resources, and several sellers bid actually, and can. So the ask price is quite a good quantity. And then we can make an analysis of the bubbles in real estate. And of course, this is an interesting thing, because a lot of Russians, by the way, invest in real estate in Switzerland, but everyone is interested in investing in real estate in general. So we can identify a number of hot districts, and now we have this agreement to release this report biannually in Switzerland, and we're trying to extend in Europe, where we see the latest output, which was just 2 days ago, on the 3 days ago, 29th of January, where we identified the red, which is critical, the orange, which are to watch, which are approaching the bubble phase, and the violet, which have been through bubbles, but we think that they are now on the consolidation phase. So this is a very interesting tool to follow what is happening. This is a list of a place that doesn't speak to you. What is interesting, by the way, you can follow as a movie what is going on. For example, here you see our previous study in 2012, fourth quarter, and you see where I live here. It's the tip of the lake of Zurich here. This is where Zurich here. You see the arrow. And you see in 2012, these were the districts, the places, the cantons, where the action on bubbles real estate were going. And then 1 year later, you see a kind of extension wave going further from the central agglomeration. And there are very interesting discussions about what is going on in Zurich, in certain places, also Genova here, and so on. We can also use, and this is a result that we have obtained very recently, of analyzing global real estate markets. You see in Australia, Belgium, Canada, and many, many others, where we identify, and this is a first rough analysis of where are the places of bubbles which are indicated by the color lines, with different columns here corresponding to different sensitivity of our indicators with respect to the type and the scale of the bubbles. I don't go into detail here. And you see, indeed, possibility of diagnosing bubbles in different countries, Switzerland, Germany, Denmark, where you see the ex-ante nature of the process, which can be extremely interesting from a policy-making point of view. Spain, Finland, France, where indeed you can say, according to analysis, bubbles are not all the time, but they are prevalent at certain times, and often synchronized worldwide or by part of region. You see the massive bubble in Japan, very, very clear, South Korea, Luxembourg. There are now indeed signs for some countries of developing bubbles, but this is not the general scenario. This is a concern, of course, for Switzerland. Jumping to the last part, which is now the cockpit, to look at all assets beyond real estate. We were interested to look at, so let me show you what we look at. We look at fixed income indices, government, fixed income, corporate, equity indices, all types of countries, sectors, and special sectors, commodities and currencies. So we scan everything. We go down to a core of 404, now actually we extend to 436 core indices that best represent for the typical worldwide investor the dynamics of markets. And we introduce two indicators. The one we call it confidence. So my collaborators insisted it should be DS for Didier Sornette. So the LPPL for located parallel, and confidence and trust. So confidence essentially is a measure of the solidity, robustness of the signal with respect to the timescales, while the trust is a measure of statistical robustness of the signal with respect to the quality of the calibration of the model to the data. So we look at both, and this is the result in a synthetic way. Out of all the market watch as of just a few days ago, the machine was finalizing the data, and I received it in Moscow and this morning to adjust it. So thank you for the delay. I could actually update my slides. You see that there are mainly bubbles. 50% of equities in the sector domain are in bubble. Massive signal. In countries, 19%, and in special category, 14%. Also, so globally, 1/3 essentially of the indices worldwide are in the bubble stage. For fixed income, the signal is less strong, but still significant, and there are some currencies, 25%, which are in bubble. So this shows the number of assets that we are scanned for these categories, the number of bubbles in different assets, and the fraction, showing you a sense of where the activity is. By the way, which allows me to clarify. I am often asked, Professor Sornette, where are we in a bubble? I'm asked by journalists. What a stupid question. Because of course, there are so many countries, so many sectors, so many assets. So the point is that it's not that we are in a bubble, except the great bubbles that led to the crisis. Indeed, we have seen since the crisis many small and intermediate-sized bubbles that have been developing. And you see here diagnostics. So let me go through some specifics. For example, here you see clear bubble signal for bonds, Spanish, Irish, Italian, so the kind of Mediterranean, so to speak, even if Irish is not so Mediterranean, but in the same class of these subordinate bonds, which has been recovered lately with the impression that the European crisis is a matter of the past. But we think actually, given the risk that remains very high, the bonds are extremely expensive and they are in bubble territory. We have this indicator trust and confidence, which when, according to experience, is larger than 5%, clearly diagnose a bubble territory, which is worrisome, and you see the indicators are all larger than 5%. We have also quite significant signals for fixed income sector indices and so on. Then, going to commodities, it's very interesting. It's a kind of great connection with equity markets. Equities tend to be really in a bubble territory. Here we see weak negative bubbles. For example, you know the gold has lost almost 30% in the last year, so very significant drop. And we see that these drops, these are kind of weak negative bubbles. You see weak because the indicators are relatively low here. But we think, for example, that on a good risk-adjusted basis, there might be very good opportunities, for example, just to buy gold or to buy silver now. We think that there is an interesting opportunity. This is how it looks like when we have actually hundreds of assets associated with gold. We see these green indicators indicating negative bubbles with a potential rebound. This is how, more specifically, how one of the indicators, the confidence, just shoots up in synchrony, actually announce the rebound. You see the rebound is short-lived, and we have another indicator now, and we have, of course, a complement with the trust index showing indeed the possibility for a rebound. So also jumping to currency market, you see a kind of weakening that has been going on for a number of currency like Argentina, Indonesia, and Turkey, with quite strong signal indicators you see here, which suggest actually, and they are negative bubbles. You see the yearly return in the second column here, which suggests the possibility for a rebound, or at least we don't know what's going to happen, but at least you know what is going to happen. There is a TC. The story is going to end. Something is going to happen. Now it's quite interesting to see what the Central Bank of Turkey did on 29th of January. Probably this is not your first concern to look at this every day. They hiked their overnight lending rate from 7.75% to 12%, with an exceptional committee. Extraordinary action. And the borrowing rate, which is different from the lending rate, jumped from 3% to 8% just in one day. Enormous action. Now, how do I interpret that? This is a beautiful example of a process, the lira, which is accelerating downward unsustainable behavior. Someone is not going to like it. Who is not going to like it? The government, the central bank. They are going to do something. We are, in a sense, predicting the central bank action. Yes? By the way, in 1998, close to you, remember there was the devaluation of the ruble and the partial default of the debt of Russia. I've been told that the debt was only with respect to the, unfortunately, the nationals, not the foreigners. So, and this led to a very strong turmoil in the international markets. And in particular, DAX, German markets lost 40%, the US market only 19%, and so on. And we were monitoring this, and we saw something coming. We saw that in a number of markets, it was not sustainable, so a change regime clearly would happen. And when I present this to my dear colleagues, economists in the West, they tell me, well, totally stupid, it's clear, it's exogenous. It's exogenous, it's a default of the debts of Russia, it's a rubble problem. But are politicians so really independent of the stock market? Are they really so independent of the state of the economy? I mean, if we predict the economy, if we predict the stock market, we predict the politician, essentially. Yeah, so of course we don't predict what Epstein would do exactly and so on, whether they would have a good digestion or not, of course. But we predict the growth structural patterns of reaction and sustainability.